Social Security benefits make up a big portion of retirement income for a lot of people, and people often wonder if they have to pay taxes on that. It's an important question because any taxes you pay in retirement reduce the amount that you ultimately have left over to spend on things. So here's an oversimplified example. Somebody has a couple of different sources of income. They might have 68,000 coming in, but they can't necessarily spend every penny of that because there may be some taxes due. So it's important to understand why this happens and what you can do about it. So will your benefits be taxable? Well, the answer is it depends, but if you're asking the question, it's likely that they would be taxable. That's because if you've saved some money for retirement, the way most people do, there's a good chance that you'll have a high enough income, and the taxation of Social Security depends on your income level. There's a decent chance that you'll have a high enough income to bump you into taxable territory. So this gives us some hints on what you can do about it, which we'll get into later, but the amount of income you have and the type of income you have, basically the resources you come into retirement with, will affect whether or not you pay taxes and how much of your Social Security is included in your taxable income. If your only source of income in retirement is your Social Security retirement benefit, then you might not have to pay taxes. But a lot of people have other things going on, so they might have investment income. That could be dividends and interest and capital gains that are in your taxable or bank accounts. Those can affect the taxation. You might have a working spouse. Even if you stop working and begin Social Security, that can affect things as well. But the biggie for most people is going to be withdrawals from pre-tax retirement accounts. So if you were saving in a 401k, 403b, IRA, and you were making those deductible or pre-tax contributions, then there's a decent chance that you have a big bucket of money that has never been taxed. So as you pull that out, it is going to be taxable and included in your income. At most, only 85% of your benefit would be included in your taxable income, and the amount is based on different income thresholds, and you can get all that from the Social Security Administration. But let's say you're an individual filer between $25,000 and $34,000, up to 50% would be included in your income, and then above $34,000, 85% could be. So we've got different numbers for joint filers, and you can look all this up yourself. You see them right here, but ultimately it depends on your income. So how do they define income? What are they calling income? So you've got adjusted gross income here, and you've got to look up what exactly that means, plus any non-taxable interest. So if you have municipal bonds, for example, you would add that back in, plus 1/2 of your Social Security benefits, and that's what makes up your combined income that we're going to look at in these thresholds here. So that is federal income tax, and that's what would go on, let's say your 1040, for example, but your state might also tax your benefits, at least to some degree. So it's typically going to have less of an impact, probably won't make or break your retirement, but you can look up different states on this Kiplinger site is a nice way to get information on that and find out exactly what to expect for your state. Now, you might think that you can just manage your income and only take out what you need and stay below those levels to avoid taxation, but you have to remember that at age 72 and after, you have to start taking those required minimum distributions, or RMDs. And when that happens, you might end up taking out a bigger chunk each year than you really need to even spend, and that is big enough to bump you into that taxable territory where you start having to pay tax on Social Security. It could have other complications like affecting your Medicare premiums, for example. So be aware that those RMDs can kick in. So you want to look at some planning strategies, which we'll talk about in a second. By the way, I'm Justin Pritchard, and I help people plan for retirement and invest for the future. So in the description below, you're going to find some resources that talk about this topic and some other just general retirement planning tools as well. I hope you find those helpful. And it's time for a friendly reminder that this is just a short video. It can't possibly cover everything, so please hit pause and read this carefully. It really is important, and please do a lot more research. Speak with professionals before you make any decisions. So what can you do to make less of your Social Security taxable or to manage your taxable income in retirement? These are a couple of strategies you can pick from, and these can potentially help you reduce those RMDs that you're required to take each year after 72. And they can also just help you smooth out or level the payment of taxes and the rates that you pay taxes at during retirement. You can start by thinking about where you pull money from each year in retirement. Should you pull it from your taxable account or your Roth IRA, or maybe the pre-tax IRA? Maybe if you pull some money out and take some income, that can help you to fill up a tax bracket, for example, and go ahead and take advantage of a low income year, maybe paying taxes at one of the lower rates. A lot of times your CPA or your tax preparer might tell you, why pay taxes when you don't need to? Well, this is an answer to that, when you might actually want to pay taxes early or withdraw money when you don't even need it. You can just reinvest it in a taxable brokerage account if you don't need that money, or you can look at Roth. So that would be potentially even converting that money from pre-tax savings into Roth savings, and that way you're able to potentially level out those taxes. You can also just save money in Roth accounts. If you're still in your working years, you might have Roth IRA available if you qualify. You might have Roth 401k, 403b, etc. at your employer. If that's an option for you, you can consider using those savings vehicles as well, because those withdrawals from the Roth accounts would not count as part of that income. When we looked at that chart of what goes into your income, the Roth withdrawals are not part of that income under current law, so that can be a decent way to avoid paying taxes on Social Security and otherwise manage your tax burden. Plus, general tax-efficient investing strategies can also be helpful. So that might mean doing some tax loss harvesting if you're getting pretty close to one of those thresholds and you can bring yourself just below it. That can be helpful. You can also look at where you hold certain assets, especially if they're going to kick off taxable income versus just growing until you sell it. That can potentially help as well. And if you're over age 70 and a half and you're charitably minded, you can potentially give money directly from your pre-tax IRA to a qualifying charity, and that can help you avoid taxation because it keeps the money from ever showing up on your return. So again, this is age 70 and a half, not age 72, just to make it confusing. They used the old RMD age, or they kept that age. And if the money goes directly to a qualifying charity, let's say you were going to make a donation anyway, well, your IRA might be a decent place to take that money from so that you can manage your income. So I hope you found this helpful. If you did, please leave a quick thumbs up. Thank you and take care.